Hey guys, how you doing? This is Steve Padernacht with Keller Williams, and we are back with Mortgage Matters. We took a bit of a break. Admittedly, we were off for a couple months. Busy. There's a lot of things going on in the world, and we wanted to bring this back to be able to. I guess the best way to say it, Mike, would be just to educate people on the mortgage process.
That's really what it always comes down to, right? Educating the consumer, the public, as far as what it takes to take out a home loan. It's not as easy as any other type of borrowing that you're looking for.
Yeah, right. You go to apply for a credit card and they ask you a couple questions,
Yeah.
and they don't ever ask you for any proof, and
Yeah.
you press a button and then all of a sudden you're approved or you're not.
That's it. And if you approve, you get the card in the mail, and easy as that.
But home loans are a little bit different.
They're very different. There's a lot involved, a lot of parties involved. You have your buyer's agent, the seller's agent, buyer's attorney, sells attorney. You have the bank attorney. You have the title company. You have the appraisal company. You have the underwriter. You have the processor, right? You have the loan officer. So there's a lot of moving parts and a lot of parties involved in just one transaction.
And what would you say, and we've talked about this many times, but what would you say the two or three most important things to focus on if somebody was getting ready to apply for a mortgage?
Great question. Credit, income, and assets.
Okay.
Right? You want to make sure that a lot of your debts are paid down or paid off. Hopefully that'll help your credit scores boost up well into the 700s. That would help you secure decent, good rates. As far as assets, you want to make sure you have enough in savings, or if maybe you're going to get a gift from family members, but at least to cover what they call cash to close, which is your down payment and closing cost. As far as income, it is what it is. You work wherever it is, or you're self-employed. That's the other part too. Now that I'm thinking about it, if you're self-employed, you wanna go over those tax returns with the loan officer to see what is your net income, because sometimes that may help or hurt you.
So being self-employed, essentially you could be getting a 1099 tax form. What other type of self-employment tax forms would somebody be like? I would imagine like an Uber driver, or us as real estate agents, we get a 1099 because we're independent contractors. Are there any other forms besides 1099 that a self-employed person would show you as proof of income?
You have freelancers. You have a lot of different jobs out there that do pay consultants on a 1099, and those are fairly easy to evaluate their income.
The 1099.
Yeah, right. I mean, because you just really look at the Schedule C of the tax returns for the last 2 years, average out the income, make sure it's not declining from year over year, and then you take that net income and plug it in to see if it works with your debt to income ratios.
So let's go slowly. I'm sorry. Schedule C.
Schedule C of your tax return.
Tell me what is Schedule C.
Personal tax returns.
Okay. Yeah. So walk me through. What is a Schedule C for an independent contractor?
Yeah. So Schedule C is where a 1099 independent contractor would go ahead and report their gross income. Their accountant or the tax preparer will most cases write losses against this gross income, and the lender, for mortgage purposes, will take the net income, which is after the losses.
Gotcha. All right. So just to kind of in real estate terms, right? Yeah. Or actually forget real estate terms, because who knows who's going to be watching this video, right? So in simpler terms, your Schedule C shows your income at the top, right? Your gross income. Let's just say
call it $100,000.
Call it $100,000.
Yeah.
And then your accountant then says, "Hey, how much money did you spend on gas? Right. How much money did you spend on transportation? How much money did you spend on car payments? Whatever deductions or expenses that you're able to show legally, your CPA or your accountant will then take those numbers and deduct them from that $100,000. Let's call it $30,000 he was able to deduct. Now you're left with the number, and that's the number that the underwriter or the lender is looking at as income.
That's right. Yeah. So, and at times you have accountants that will overinflate those expenses.
Ooh. I hope anybody who's watching this doesn't have an accountant that overinflates expenses.
I mean, at times is to try to pay less in taxes, but it'll hurt you at the end trying to get a mortgage. I mean, the nice thing though is that we do, and this is not so much of a pitch, but it's more so that we have products that could get around that with a certain down payment, that we could go off of just 1 year tax returns. We could go off just off the 1099 and not the actual tax return. So we can get creative.
So it's interesting, right? I don't want to skip over this point, right?
Yeah.
There's people out there right now that are saying, hey, my accountant, I don't want to say overinflates, but my accountant is very generous when it comes to the amount of gas expenses that we write off. And I think certain things like gas and auto or whatever it may be, those are like fixed amounts. So the IRS, I think, only gives you a cap. It gives you a cap on those. I think. I'm not a CPA. Please contact your CPA.
Right.
But let's assume for the past 5 years, I've been telling my accountant, hey, deduct as much as you possibly can because I don't want to pay taxes, as much taxes as I,
Right.
as I don't want to pay the taxes that I need to pay. Let's just, be very PC here.
Right.
But now I'm getting ready to qualify to buy a home, and now I might want to say, hey, this year, don't overinflate those numbers because I want to show a higher 1099 or a higher gross income. Does that make sense?
Totally. And that's a conversation I always have with self-employed buyers.
The interesting part is that the most important part of that is being prepared and planning 6 to 12 months ahead of time, because that's not something, once it's done, it's done. Once you file it with the IRS, I mean, you can file amended tax returns, but for the most part, it's done. Your average person's not going and amending tax returns to clean up some of their.
That's right. And then they have to pay a big nut back to the IRS, which they're not prepared for that either.
Yeah.
Right. So it's always best to sit down with a loan officer, one that's an expert and educated in all the programs, right? That can help you and consult you as far as what type of conversation you have with your accountant. It's free consultation. Doesn't cost anything to have that conversation with the lender.
I tell people the same thing, and you and I have talked about this numerous times, right? Like, the analogy that I like to use is like if you're planning a vacation that you're going to spend 5, maybe 10 grand on, you usually plan it 6 months ahead of time.
Right.
But people will go and decide to go buy a house and say, I want to buy a house next month and not be ready for it.
That's right.
Like you're spending probably, this is for most, your average American buying their home is going to be the largest investment or purchase they're ever going to make. But they're not preparing properly. And I guess what I'm trying to get at is like, if you're looking to buy a home, then you should be preparing at least a year ahead of time. And I think a lot of people do, but a lot of people don't. And then they're like, okay, now they get their hopes up. Like, yeah, let's go buy a house.
Yeah.
I just whatever, won $100 grand at the football pool in the Super Bowl. And I'm like, all right, Mike, I want to buy a house. Like, wait, buddy, you're not ready for that yet.
Right. Oh, they go and lease a car. Right, right, and that really hurts your debt to income ratios, because for you it's much easier just to have this beautiful car sitting outside than actually building net worth equity into a home.
Well, and I told you that I almost made that mistake. I was looking to, you're helping me with a purchase right now, and God willing, but I went to the dealership and I was like, all right, I needed a new car, and Jen was like, what are you doing? I was like, yo, you're right. I can't.
And it's not easy. I get it. I mean, we're all attracted to nice cars, nice things in life, but they're expenses, they're debts, right? That will hurt you.
So just walk me through what that means. Why would somebody not want to buy a car if they're thinking about purchasing a home in the next 6 to 12 months?
So every lender does what's called a debt to income ratio analysis, right? They want to see how much debt somebody's carrying on their credit report besides the proposed mortgage payment or housing payment that they want to take out or qualify for, right? And in most cases, the banks won't allow more than 49% of their monthly income to go to all this debt.
Okay.
Right? And there's other programs that are a little more conservative than 49%, and there's other programs that allow to go even up to 57%. Right? But if you're carrying too much debt, your buying power decreases, because the bank's going to look at this and say, well, you cannot take on this mortgage payment because you are paying all this debt on your credit report. And unfortunately, we have an affordability problem here in the country as far as buying a home, because homes are expensive. Yeah. So the average mortgage payment, where it used to be, what I remember, $3,000 a month, now you're probably talking about from $4,000 to $6,000 a month, depending on your loan amount.
And as homes have increased in prices, so have the cost of cars.
That's right.
So your $600 or $700 payment that you're going to be making on your car now is going to be able to is affecting the amount of debt you're allowed to carry based on your income levels, right?
That's a great point.
Now, the other thing is, and what does applying for a car loan do to your credit?
It can ding your credit a little bit, right?
A little bit. I'm gonna push back on that, dude.
Okay.
I'm gonna push back on that.
All right.
Credit. Be so careful when you're going to buy a car, because what they'll do is they'll send it to one person, and then if it doesn't come back with a good rate, they'll send it to another one, then they'll send it to another one, then they'll send it to another one.
Yeah.
Now all of a sudden you've got five or six hard inquiries on your credit report. And those things take a decent amount of time to get removed, and they're going to drop your credit score. You can go from a 700 down to a 650 like this, walking into one car dealership on a Saturday afternoon.
And most dealerships won't tell you that.
Oh, no.
They have shopped your credit through different financial companies to figure out what is the best rate that they could offer you.
Yeah, and this is surely not a podcast about buying cars.
Definitely.
But here's a little tidbit. Go online, get your own financing before you walk into the car dealership, and now you're negotiating the price of the car instead of negotiating the cost of your payments. Most people walk into a car dealership and they say, hey, you know what, I want to spend $500 a month. So what the dealer is going to do is they're going to figure out a way to bang you out for as much interest and whatever as possible to try to make your payment $500 a month, instead of walking in there and what you should be negotiating is the sticker price on the car.
MSRP.
Yeah.
Right.
So that's just a little side note, right? We're not selling cars here, but
No.
This is experience stuff.
Yeah. We're trying to help you guys out there to buy homes and build some equity in your in your portfolio.
All right, so I want to just switch gears just a little bit. What are you seeing right now? What are you seeing right now in the terms of like rates? I hear different things. Rates going up, rates going down. For the most part, in the past 2 or 3 months, I've been hearing that they're steadily, starting to cool off a bit. Are you seeing the same thing? Is that accurate?
Yeah, I mean the rates have been in a range anywhere from 6% to 6.25% on a 30-year fix. Right?
Okay.
For the most part, there haven't been a lot of movement in rates because the government has been shut down for whatever it was, 45 days.
We are now on the other side of the government shutdown.
Right. But
as of this recording.
Yeah, but you're right, correct. But there wasn't a lot of economic data coming out where the market could figure out where the bond market and rates need to go.
Well, hold on a second. I don't want to, because you and I talk about this stuff like as if it's common knowledge, right?
Yeah.
But the shutdown affected rates because there was nobody working to be able to create these reports. Am I correct?
Somewhat, yeah. Right. I mean, so there's not a lot of data that could be obtained from these companies, from the Federal Reserve, to figure out, okay, what actually is going on with inflation, what's going on with the labor market, and all that drives mortgage rates.
Yep.
And I also want to add that when the Fed does cut rate, because I get these phone calls a lot, does not mean that they're cutting mortgage rates.
Yes.
They're cutting short-term lending, which is your credit cards, the car loans that we were just talking about, those type of loans. Really what drives rates is the 10-year treasury bond market.
Yep. So, because you'll see, like, that's the thing, right? Like, what comes on the headline of the news? Fed cuts rates by 0.5 point. Immediately, people are calling you saying, Mike, you quoted me 7%. Now does that mean it's 6.5?
Right.
And then you have to be the bearer of bad news and tell them what?
Well, I explained to them, I said, unfortunately, that's not the way mortgage rates work. It helped your credit cards. It helped if you have a home equity line of credit. That has decreased now. But as far as mortgage rates, it doesn't go hand in hand. It's just like I said before, it's really driven on the bond market, which is the 10-year treasury.
Mm-hmm.
They go parallel. So that's really the driving factor, and it's going to be based on reports such as the labor market and inflation. So if inflation's coming down and there's weakness in the labor market, that helps improve mortgage rates.
Gotcha. Okay. All right. So if you Mike's crystal ball, right?
Right.
What do you see rates doing after the new year?
Well, they're projecting rates to keep coming down, right? But they're not sure how much there's going to be changes of this current market with the future. I mean, we may possibly see rates in the mid to high fives next year.
Ooh,
You
yeah.
know,
All right.
and for me, I mean, I think that's when you're going to see a lot of activity in the market. Once rates get into the mid fives, I think that's the magic number that I think it'll get sellers off the fence, get buyers back into the market because affordability is coming back a little bit. But you know, and then you know the year after that, maybe we'll see rates in the low fives. You know,
Yeah.
it's all really depends on what ends up happening in the economy.
I think the fives are like the sweet spot.
They are. I believe so. Yeah. And I mean,
Fives
there's
are the
been
sweet spot,
studies that you know those have purchased homes and taken out rates into fours. You know, jump into a 5.5. It's not the worst thing, right?
Yeah.
It's not.
Yeah.
You're not taking a big hit on your increase of a monthly payment.
Gotcha. Okay. All right. So I think that we should explore doing this live more often.
That'd be great.
I feel
I
like
can't-
this
you
was
know,
a little bit.
Yeah, I feel like this is. We should be like in a cabin with fire. We're just talking about the economy. I mean, this is cool. I like this.
Yeah, it gives you a little bit of a different vibe.
Right. Yeah.
Right?
Yeah. This is great.
We just have to get our cameraman and our audio guy to set it up a little bit. You know,
We got to
more-
talk to the production company.
Yeah, we got to talk to the
because-
production company.
because he is I to say the least he's I guess trying.
He's working hard.
Yeah.
He's working
Right.
hard. His heart's in a good place.
Right.
Just know that, people. His heart is in a good place. Our
really
production,
is, yeah.
our producer.
Yeah, our producer, right? That's right.
And I'll put his credits down in the description, so that way, in case you want to shoot a podcast, you could contact
That's
him
right.
directly.
That's
All right, so I have no idea what episode this was because it's been a while.
Yeah.
But we're back.
And by the way, I'm filling in big shoes right now.
You are filling in tremendously big shoes.
Right. My manager, Christian Babcock, used to do these with you,
Yeah.
right? And you guys were amazing. Christian is a wealth of knowledge. I've learned so much from him.
Yeah.
If it wasn't for him, I'm not sure where I would be. But in any event, it's just I'm privileged to get this opportunity.
Well, listen, you have done a great job, I think, filling in. I don't get to see your numbers. I'm sure Christian has the same viewpoint, but maybe not.
I believe he does. Yeah. He's on top of it. Yeah.
But Loan Depot as a whole, I'm sure misses having Christian around.
Oh, they do.
And
Yeah.
he is recovering. For those of you that are watching, Christian's dealing with some stuff going on, but he is in our hearts, in our prayers. And
Absolutely.
Christian, when you see this, big shout out to you, man. We miss you. So if people wanted to get qualified for a mortgage right now, Mike, how do they get in touch with you?
They could call me at 646-772-9461, or they could even go on my website and start an online application. It's a soft credit check at www.loandepot.com/M Plata.
And I'm going to put that in the bio, in the description as well.
Perfect.
All right,
Awesome.
man, this was cool.
This was awesome.
This was
cool. And everyone out there, just enjoy. Hopefully, you have an amazing Thanksgiving with your family.
Is next week Thanksgiving?
In 2 weeks.
Oh, no, we'll be back next week.
Perfect.
Nah, don't worry about that. So don't wish them happy Thanksgiving
Yeah,
yet. We're back
not
next
yet,
week.
not yet, yeah.
And it's going to be on you to make sure you're back, so that way we can
I
do
can't
this.
wait. Can't wait.
Everybody, thank you very much for listening. Hopefully you learned something today. I surely did. Mike, I appreciate your time.
Thank you. For
And
giving me the time.
again, man, Christian, take care, buddy. We miss you.
You're the best.
All right. Bye, everybody.